Wednesday's session saw markets react to the Fed's rate decision, big tech cuts driven by AI, and Amazon's deepening AI bets challenging Nvidia. Stick around for today's daily brief covering Wednesday, June 18th. Ahead of the Fed announcement, indices traded within a tight range. After the Fed held rates steady, major indices finished roughly flat as investors parsed the Fed statement and dot plot projections. But under the surface, traders rotated between rate-sensitive sectors and tech names exposed to the AI trends. Therefore, while headline moves appeared muted, the real story was shifts between sectors and bond yields reacting to the Fed guidance. Let's unpack the Fed's decision first, then move to some of the tech headlines that shook sentiment. No surprise here, the Federal Reserve kept rates unchanged as the market widely expected. Chair Powell noted that while inflation cooled closer to their target, elevated long-term yields and geopolitical risk have them continuing to be patient. The updated dot plot still signals 2 Fed rate cuts by the end of this year, citing uncertainty from tariffs, energy prices, and global tension. Because the Fed is balancing a desire not to choke off growth with renewed risk of inflation, markets are digesting a patient but data-dependent stance. Therefore, Treasury yields dipped slightly after the announcement, lifting rate-sensitive sectors such as housing and consumer discretionary. As yields recalibrated, tech news took center stage, first with Amazon and Microsoft announcing job cuts due to AI. Both Amazon and Microsoft signaled further workforce reductions based on AI-driven efficiency. Amazon CEO Andy Jassy warned employees that AI integration will lead to a lower corporate headcount over the coming years as routine tasks begin to get automated. Now, because Amazon has built thousands of generative AI services in-house, it now plans to leverage these tools to streamline many operations. A move that, while boosting margins, raises concerns about job displacement. Meanwhile, Microsoft is planning thousands of job cuts, particularly in their sales role, as the company reallocates resources towards AI investment and expand dataset to underpin Azure's AI services. Now, shares of Amazon and Microsoft did end up underperforming the market, even as their longer-term AI strategies remain viewed as positive by investors who see potential for margin expansion. Beyond workforce shifts, Amazon also unveiled a strategic AI development could chip away at Nvidia's stronghold. This week, Amazon announced that Anthropic's Claude Opus model is now being trained on the AWS Trainium chips, its in-house AI training silicon, marking a milestone in AWS's push to reduce reliance on NVIDIA GPUs. Analysts note that training a cutting-edge model like Claude Opus on Trainium 2 underscores Amazon's drive to lower costs and improve margins in AI workloads. Because Amazon's bespoke Trainium chips can deliver up to 50% cost savings versus NVIDIA GPUs, using them for heavy model training signals that hyperscalers could significantly help their margins if they're able to do some of their training on in-house silicon. Now, while NVIDIA remains dominant in AI training, inference, and really the broader AI ecosystem, AWS's success with Trainium-based training could begin to pressure NVIDIA's monopoly in the AI chip market. In other market moves, financials performed well due to U.S. bank regulators announcing a plan to ease regulation on capital requirements. Now, because the Fed's cautious guidance keeps rate cut expectations alive but uncertain, and geopolitical risk remain elevated, markets may continue to see shifts between defensives and growth-focused sectors. Let me know your thoughts below. Do you think AWS's Trainium push meaningfully challenges NVIDIA? And as always, like and subscribe for more content and more contact.